Rob's Child. Nothing I say is investment advice. I wanted to share a thesis I have with you today regarding interest rates. I've been buying a lot of long duration treasuries. I bought a lot between the recent range of, with a 30-year bond going between 3.6 and 4%. I recently put a lot more in to long duration treasury bonds. I have effectively a yield of that's averaging 4.3% right now after buying a whole bunch at the 5% rate that we are basically at today. I think that this is abnormally high for interest rates to be, and I don't think it's going to last long, and I want to go through my reasons why I believe that. And in disclosure, like I said, I am currently invested in a lot of treasury bonds. Actually, it's 31% of my current investing portfolio, along with 11% in cash, which I'm planning to put all into long duration treasury bonds like TLT or ZROZ, if you're not familiar with ETFs that are available that have exposure to that. And then I have 58% in equities. The equity side of my portfolio will benefit if all the economies, the world economies, will be resilient and strong, and we have more inflation that will benefit the equity side of my portfolio. And then if we go the other way, with disinflation, deflation, that's when the bonds will take off, and then I'll be able to put more into the equities. And either way, whichever way it goes, I can balance what I am essentially holding, which is essentially a 60-40 traditional balance of stocks and bonds type of portfolio. So here is my thesis on, and I have a lot of good data I'm going to share with graphs and everything to try to back this up. The thesis is that expecting higher rates, which I see a lot of people doing right now, especially on the long end of the curve. We hear people saying, 5.5%, 6%. Even Lynn Alden is suggesting that, we're going to have a prolonged period of higher inflation, which I assume she means that long duration yields will at least stay elevated, if not even go up higher. It seems like there is a lot of fear out there in debts, and I'll show you a few articles on that too. And I think all of this is actually largely recency bias. So there's two parts to the recency bias. First, the wave of rates going higher, first on the short end, and more recently on the long end of the curve. We just recently spiked up, and I think that's scaring people away from bonds a lot right now and driving yields higher. And I think a lot of investors, especially older investors who lived through the 70s, saw the 30-year bond get to around 15%. And I think that's caused a lot of recency bias in their expectations for long duration interest rates. Now, a lot of you can say, like, okay, well, interest rates are kind of like just a part of nature, and they'll just go way up sometimes and way down depending on various factors. I know one of the big arguments with higher rates is involving the debt, our current debt situation, which is 100% of GDP, I understand right now. And I guess once you get to this point, some people are saying the the higher the debt cost goes, the higher the debt goes, and then the lower the prices of the bond goes, and you end up in this spiral of bond prices continuing lower. And again, if that breaks, we can probably expect the Fed to step in once again and start buying up the long end, increasing their balance sheet again. But I'm gonna right here tell anybody that doesn't know about Lynn Alden and her newsletters to read the October report she put out recently. It's excellent. It gives a really good perspective. But I think I can. I'm not claiming to be smarter than her, but I think that I have arguments that go against some of the way she's thinking. But I digress. The first big point I'm trying to get across is that the expectation of higher rates, especially around 5%, is involving recency bias. And the biggest reason I can come up with for this is we need to understand that this is a debt instrument coming from the most stable, strongest country in the world with the reserve currency, number one, and that this is a guaranteed rate of return. This is the guaranteed rate of return. You're not going. The U.S. will not default on this debt. It's virtually impossible. Those two things combined need everybody that thinks that long duration rates are going to keep going up, they need to slam on the brakes and say, hold on, you're guaranteeing me that high of a yield for 30 years, on the long end of the curve. It's right around 5% right now. And I think that and I'm going to show you some charts. So I found this chart from visualcapitalist.com showing the visualizing the interest rates throughout history, and it says it's a 670-year chart of interest rates. Now, these Dutch perpetual bonds, I tried to look up what they are, and I was trying to understand. I think this range here is like the potential range of what these perpetual bonds were yielding. I'm gonna scratch these off. I don't think there's a whole lot of great data to back up what these rates are. I'm not sure where they got them. I think there's a little bit more dependable data going through the rest of this chart. But what I wanted to do mainly is just show through this 670-year chart these numbers here from a percentage basis. So what I did was I drew a line at the 5% marker. And as you can see, I can even scroll down. I was going to draw a box here. As you can see, if I cover up 5% and below, and you see the squiggly lines up top here, there's not many times. We don't see a whole lot. It does pop up there sometimes, and sometimes, like in the 70s and 80s in the U.S., it pops up really, really high. But if I switch it around and cover up the top, we can see it looks to me like the great majority of the time, with very few exceptions, we have a range going mostly between 2 and 4%. We rarely even get up to the 5% marker. And I mean, again, this is 670 years of data. Now, when we take this into account and we combine it with the fact that in the U.S. right now, the target inflation rate is 2%, and we're having we have basically a 5% yield guaranteed on the 30-year treasury. That's a real yield, of 3% for 30 years, a guaranteed real rate of return, um, which is different than nominal. It means that your purchasing power goes up as you hold that at a guaranteed rate, locked in for that long. Again, this is part of my thesis. I think bonds are cheap. I think bonds are worth buying right now, in particular treasury bonds right now. All right, so we consider, what are normal rates. It seems to me like normal range is usually between 2 and 4%, and anything above 4%, especially around 5%, is more rare than it is normal. Again, people that lived through the 70s, they're like, well, it could be anywhere. But you know what? People living in the 1500s, 1600s, 1700s, 1800s, and early 1900s would all disagree probably with you. That's what I'm trying to get at here. For a guaranteed return. All right, so just to go through the rest of my charts. By the way, any ads that you see on the websites are not, I'm not getting that. They're just on the site. That's not me. So here's the 30-year bond yield. From a chartist's perspective, I was buying in this range here. I was trying to buy when it was higher, but I was buying when it was lower as well. And then we shot up. I bought more there. We shot up, and I'm buying more here. And I'm hoping actually it stays here and stocks rally while I can sell my stocks and trickle more into this. Maybe even get some more of my cash in at a higher rate if it ever goes higher. I don't really, I'm okay right now with the 31% I have in treasury bonds at this level, because that, when that goes back down, look at 0Z. It's a longer duration than TLT is. It's not. It wouldn't be that crazy to get back to this level, and that would be doubling the investment there from treasury bonds. But yeah, from a chartist perspective, you see this collapse here, and then the flag here, and it broke. I might have done better if I had, after it broke, for me to sell here and then wait for this area and load in. I wouldn't be sitting on as many losses at this point. But yeah, my cost average basis with 31% of my portfolio right now is at about $82. So that's right here. So that's my average at that line. But anyway, yeah, just to go through the rest of the things I have ready to share. You have Ray Dalio talking about the New World Order, something like that. Yeah, or changing world order, how countries at the top don't always stay there, and and at this point it seems like it's more of a fantasy that his book is going to play out, and he's going to be right about this move. And I mean, we have been going in that direction to some degree, but to predict World War III, is that really Ray Dalio? That's where we're at. I mean, he could be right. Maybe I'll be wrong, and sighing about it and being like, what are you thinking here? But let me finish. Let's go through the rest of the things I pulled up. We have all these people saying don't buy debt, don't buy bonds. I heard Ray Dalio We heard also from Jamie Dimon, the CEO of JP Morgan, most dangerous time in decades. A lot of people are, there's a lot of fear with these big guys. These big, powerful guys have a lot of fear right now. And I don't know. I don't know how founded it is or not. But the last thing I wanted to show is this website, the loweinstitute.org, military capability. It charts the power of the United States. And so if we were just to simply take these numbers here, and this is only to emphasize really the stability of the U.S. and its power and its wealth in the world, and its place in the world, its respect for the world to depend on as its rock that everybody depends on. We're maybe the new world or the order will change of countries, but I don't think we're there yet. Even look at these charts here. We have 91 is the military capability compared to China being at 68. So if it was China versus the U.S., it's pretty clear who would win. I guess if you had Russia and India somehow join together and fight the U.S., they might be able to beat the U.S., or certainly Russia and China. If they joined forces, maybe they'd be able to beat us today. But I mean, think again, even with that scenario, think about if we were really ramping up for war. The U.S. right now, and this goes into what Lynn Alden said herself and other people are pointing out, is that our interest payments are higher than what we're paying for our military. A lot of people are citing that in different ways, and I want to cite it in a different way. I want to say, well, to me, that just means that, I think we probably have the capability of ramping up our military to be much more powerful than it is, and we're just not. We're just we're getting comfortable, a little bit. Maybe we shouldn't be so comfortable. Maybe it is time to ramp up our military and become, more obviously the head country in the world or something like that. By the way, none of this is political opinions either. My current position, I'm not allowed to share political opinions. This isn't political opinions. This is just like, world, speculations as to what's going on, in the ways that I was just discussing. I hope that's fairly obvious. So anyway, the overall picture here, in the economy, I mean, I do see a slowdown. I see how, these job reports are coming out. They look strong, kind of, except for the fact that you have people that were making $150,000 a year now working 2 jobs that pay $20 an hour. And so, now the economy is stronger because he just had 1 job before, now he has 2. And, people are running out of money. Their savings are getting drained. Credit card defaults are going up. Bankruptcies are going up. It's all culminating to show we are headed into some weakness of some kind. It's hard to, again, like trying to time these things and predict things is too hard for anyone to do very accurately, because if you could, as I've said in other videos, if you could predict the future accurately, you could make yourself infinitely wealthy, and no one can do that. So, but yeah, so, in where we are in the business cycle in the tightening part, just like Michael Burry said a while ago, the next stage is earnings contraction, and I think it's starting to turn over. If I was looking earlier today at the total earnings per share of the S&P 500. I think it has been going down a little bit over recent months. But again, is this one of those dip for a little bit and go back up? It's like, and then, you know, we stay tighter for longer, and it's hard to say what's happening. But, you know, the risks that I'm taking, again, my own allocations, it's a 40-60 right now. Basically, it's really 30% in long duration bonds. Funny enough, cash yielding higher than the bonds, right? With the yield curve being so inverted right now. And then holding on to stocks for inflation, especially stocks that will do well in an inflationary environment. I like silver miners. I like uranium miners. I like Brazil. I like China. And that's it. Hope you enjoyed this video. Rob's Child.